Good afternoon, everybody. We're going to get started here. My name is Jamie Dreyer. I'm in the Commercial and Finance Practice Group at the Downey Brand Law Firm. Thanks, everybody, for dialing in. I'm going to do a brief introduction and then kind of turn over the discussion to our panelists. We think we have about 45 minutes of content today. And at the bottom of your screen, there should be a blue chat bubble. If you have questions while we're talking, go ahead and send them to us. If we're able to, we will get to them towards the end of the presentation. If we don't have answers, we may acknowledge as much. Little disclaimer here, some of our clients are on the line and many of you are not clients. And for all of you, we appreciate you joining us. Please don't construe our discussion today as giving legal advice or forming an attorney-client privilege. Topics today, we are going to focus on nonprofits. A lot of what we're going to go through today is broadly applicable to nonprofits and for-profit enterprises, but we are going to focus the discussion on elements that are directed to nonprofits. Some of what we talk about today may have been covered in previous webinars. Some of you have participated, some of you haven't. And so I would suggest as we're going through the material, if you have more in-depth questions about some of the elements, it might be worth going back and taking a listen to our prior webinars, which are on our website at downeybrand.com. We'd like to acknowledge the YOLO Community Foundation, who's on the line and who reached out to the firm to discuss some topics and as part of an outreach to their own constituency, and they've been a valuable partner, and we appreciate them being on the line and expressing interest in our discussion today. So the agenda for today, Lizzy Dollard, partner in our employment law group, is going to go through an employment update with issues attendant to nonprofits. And then Aaron Johnson, who's in our corporate and tax department, is going to go through some tax issues and some board and governance issues. And then finally, I'm going to finish with some discussion of economic stimulus and financial assistance packages directly applicable to nonprofits, some solvency issues, some general discussion about fundraising if we have time, and some other things. So with that, I'll go ahead and turn things over to Lizzy Dollard.
Good afternoon, everyone. Thank you, Jamie, for that introduction. Again, my name is Lizzy Dollard, and I'm a partner here in our labor and employment practice at Downey Brand. I'll start off by saying that nonprofits and how nonprofits get through this, I don't know what else to call it, but unusual and unprecedented situation is something that's pretty near and dear to my personal heart. My other unpaid job is as chair of the Sacramento Zoo Board, and so believe me, I get it. This is a challenging time for nonprofits, and we have been working through on a daily basis not only legal issues, but also just the general issues that come with trying to navigate not only how we get through this, but how we look when we come out of it. And so hopefully what we do for you today is give you some basic information, hopefully a little bit of peace of mind, and then at least some ideas about where to go for more information about the questions you may have on how to apply these issues to your own organization. So the first thing, we have two questions that I put up as general topics for my portion of today's presentation. The first of those questions is, how do the expanded paid leave obligations under the Families First Act, FFCRA, impact nonprofits? First, I just want to do a general overview of those obligations. The reality is, the quick answer is they impact nonprofits because you are subject to and eligible for, we'll put it that way, the carrot and the stick, taking advantage of these paid leave requirements and also, of course, providing these paid leave benefits to your employees. This act went into effect on April 1st. Initially, if you are a covered employer, which means you are an employer with fewer than 500 employees, you are covered, and therefore you have an obligation to post a notice regarding the benefits and requirements of this act. It's an informational poster that was put out by the Department of Labor. It's available at their website. I believe it's also available at our website and has been for some time at www.downeybrand.com. I'll do my plug. And so you can get that poster if you haven't already circulated it to your employees. I would recommend you take advantage of that. And again, of course, because many of you have your employees not working with you and you're not in contact with each other, there are provisions that allow you to meet the requirement for, quote, posting it by emailing it or direct mailing it to your employees, or posting it on, if you maintain an internal or an external website, something that your employees have general access to. In terms of the benefits themselves, again, by way of a brief overview, the paid sick leave benefit requires employers to pay up to 2 weeks or 80 hours. For part-time employees, that's going to be equivalent to 2 weeks pay, or 2 weeks equivalent hours, I should say, of the paid sick leave based on their regular rate of pay, and you pay it at 100%, capped at $511 a day, or $51.10 total, if the employee is in one of these three buckets, which is subject to a federal, state, or local quarantine or isolation order related to COVID-19, has been advised by a healthcare provider to self-quarantine related to COVID-19, or is experiencing COVID-19 symptoms and seeking a medical diagnosis. There is another category which provides 2/3 of regular pay, capped at $200 a day and $2,000 total. If the employee in this case is either caring for an individual subject to an order or self-quarantine, caring for their child whose school or place of care is closed due to COVID-19 related reasons, or experiencing any substantially similar condition as specified by the Department of Health and Human Services, that's sort of the catch-all at the end, and we haven't really seen much application of that in any event. The FFCRA also put in place expanded paid family leave benefits. This may be real news to some of you who've never had to worry about the Family and Medical Leave Act or the state equivalent because you've never hit the threshold to be covered. So for those of you who are not familiar with this, the Family Medical Leave Act benefit provided under FFCRA is separate from, in addition to, what otherwise would be available under federal law, and this benefit is only available for individuals who fall into one of the categories I just described, which is individuals caring for their child whose school or place of care is closed due to COVID-19 related reasons. In this situation, the emergency paid sick leave is eligible, an employee is eligible for that regardless if they started with you the day before or have been with you for years. The FMLA benefit, you have to meet a minimum 30 days of employment requirement in order to qualify for that. This benefit, consistent with the emergency paid sick leave benefit, is only for 2/3 of pay, again, and that'll go for up to 10 weeks, capped at about $12,000 total. Think of it as $10,000 more on top of the $2,000 that was capped for the emergency paid sick leave. So, of course, that's the stick, the obligation. In terms of how you pay for it, it's paid for via your refundable payroll tax credits. So, essentially, the way it will work is that you receive 100% reimbursement for the paid leave, and you can offset it against your payroll taxes, and if that cost exceeds the payroll taxes that are due, it gets provided on an accelerated basis by the IRS. The idea being that you're responsible for paying it, but the hope is that it's then immediately offset by your payroll tax obligations. The only other thing I wanted to point out, because I know we have quite a big range of nonprofits on the phone, is there is a certain exemption available for smaller organizations with fewer than 50 employees. You can be exempt from the requirements of these paid forms of leave, but that exemption only is for the leave due to the employee's need to care for a child that is whose school or child care provider is closed. So you can see it's only one of the options. But in the event that you do qualify for that, there are certain requirements that need to be satisfied about essentially the financial burden on the business in order to meet that obligation. And so if you are a smaller nonprofit and you are faced with that issue, you might want to consider working through the exemption and seeing if that's a way, if you simply can't, what I want to say, if the obligation itself would be too financially burdensome and there are other requirements that need to be met per the temporary regulations, that might be an obligation that you could be exempt from paying. And with that, I would say in terms of how this impacts nonprofits generally, the reality is, and as the regulations reflect, you need to make sure that you understand when you have the obligation to pay these forms of leave, and that you do so in a way that not only meets the requirements of this federal law, but also, of course, that meets the requirements of existing California law with respect to employee rights. And so, as always, making sure that you stay on top of when you're giving it, who you're giving it for, maintaining confidentiality when you're requesting the information you need to decide whether folks are eligible. All of those things still apply. This is simply a benefit that fits into your general scheme for how you treat your employees. The second question I have on my list is, what are the options for addressing workforce reduction in the face of what's going on right now? And obviously that's not a positive or fun topic, I'll say, but generally speaking, there are a few key buckets where decisions about workforce reduction fall into. So the first, of course, would be layoffs, which are essentially it's an involuntary termination, and that indicates a permanent indication of separation from the employee, right? So if you're going to go ahead and lay off or terminate employees, that means that you are essentially also terminating their benefits, and you are triggering all of the obligations you would otherwise have under the labor code with respect to final wages, vacation payouts, COBRA notifications to the extent those are applicable, all of that. Again, a layoff is a termination. And so if you're dealing with that situation, you have to make sure that you're, again, complying with the standard requirements that would otherwise apply, notwithstanding the current pandemic. Another option that many organizations have pursued, simply because there's a lot of uncertainty, is temporary layoffs or furloughs. Again, a furlough, there are varying ways that these are being implemented. Some are simply workers have been home and they haven't been working at all. Some have been off for certain periods of time and then they come back. I would say, the key distinction here, remember, a furlough is a temporary form of layoff. So it's the kind of situation where you could continue the benefits for your employees while they're off, for example, health insurance, things like that. But of course, in these situations, you have to make sure that the applicable plans allow you to do that. And so just one note, if you are doing a furlough plan with your employees or some of them, you should make sure, to the extent that you're providing benefits, that the benefit plans allow for employees to receive those benefits if they are not working a certain minimum number of hours, for example. The other thing I will caution you is there is state of California guidance via DLSC opinion letters from years ago that essentially if you are furloughing an employee and you either know when you're furloughing them that they won't be back within the pay period, or that furlough extends beyond a single pay period, that effectively the state of California is going to view that as a termination for purposes of final pay requirements. The reason I note that is because if you do have employees on furlough who have accrued leave or PTO, things like that, you need to work through whether or not you're triggering those final pay requirements when you're deciding whether or not you are leaving them home. And then the next category I would say also that falls in here is, although there was an executive order, the governor back in March via executive order suspended the notification timing requirements under California WARN, which for those of you who I would hope are not familiar with this, it's requirements for notice in terms of mass layoffs, reduced hours through EDD under California employment insurance, but also the expanded federal benefit that has now been made available. And so certainly if you're looking at that kind of scheme, you want to make sure that your employees are aware of and you help them to facilitate any claims that may help make up for that loss in income. And then my final comment on this section of my presentation is, I encourage you, as always, when you're thinking about things like layoffs or furloughs or even partial reductions in hours for various parts of your staff, remember a few key things. Think about the applicable local requirements, whether or not you are satisfying essential function requirements and you have the right people that you're having come to work. Make sure you think about how easily and the appropriateness of how you have to administer the various staff coming in and out, and whether you're getting sufficient work benefit out of the schedule that you're creating. Of course, remember safety concerns for your employees if you're having them come in, if you're having them telecommute, making sure that those factor into your employment decisions. And finally, of course, we always want to make sure that you consider that all of your decisions are free of any concerns about discriminatory intent, so that when you make a decision about who gets to work, who doesn't get to work, who gets more hours, that you're doing so in a way that is fair and consistent with general requirements under California and federal law. And with that, I will end my portion of the presentation, and I will be turning it over to Aaron. Yeah. So thank you very much for your time, everyone.
Good afternoon. My name is Aaron Johnson. I am an attorney here and a counsel with Downey Brand. My background's in tax, corporate, and corporate matters, and so wanted to discuss a few of the things that would be of interest to you and likely applicable. What I want to talk about first is the available tax relief to nonprofits. The first thing is the extended deadline for filing your 990s, your information returns. You've seen a lot about tax returns being pushed back to July 15th. There was no direct information initially about whether the Form 990s were also included in that, and even up until earlier this month, there was confusion as to that. But the IRS did issue a notice, and they stated that Form 990s are due July 15th. For any returns that are due between April 1st and July 15th, they would be due July 15th. So really that affects nonprofits who have a fiscal year end of November, December, January, technically February, but those deadlines would be July 15th anyways. So there has been an extension of the filing deadline. The other few things I want to touch on is related to employment taxes and the credits or available relief that's available there. Liz spoke on one of them, but there are a few others to make mention of. The first one that Liz addressed briefly was the emergency paid leave credit that's under the FFCRA. And in essence, it is for any of the emergency paid leave that you pay under the FFCRA, you get a tax credit for that. It is a refundable tax credit, meaning that if the amount that you pay under the emergency paid leave exceeds the amount that you would have to pay in federal deposits, then the IRS will issue a refund. The credit goes against the federal deposits that are made, and it's retained against the withheld federal income tax, which may or may not apply depending on whether you have unrelated business income, but also the employer share of Social Security and Medicare taxes and the employee share of Social Security and Medicare taxes. Now this is a credit that does apply to all businesses, but nonprofits are specifically included in it. If you need to get a refund on it, there is a Form 7200 that would be filled out, and the IRS works in an expedited way. They're working to get it expedited as far as it getting processed and the refund amount sent back to the business so that they can stay afloat. The second relief option for businesses, for nonprofits, is the payroll tax deferral. Now, this comes under the CARES Act, which is the third act that was passed by Congress relating to the coronavirus. And what it is that the nonprofits can defer the employer share of Social Security tax for any payroll taxes that are paid between March 27th and December 31st. So for the employer share of the Social Security taxes, they can retain that from the federal deposits, and they don't need to pay those until half of it would be due by December 31st, 2021, and the other half would be due December 31st, 2022. The one caveat with this is that if your nonprofit has applied and obtained the loan under the PPP Payroll Protection Program. I just go with the PPP. But if you obtain a loan under that, then you're not eligible to do the payroll tax deferral. The other tax relief option is the employee retention tax credit. This is, again, another refundable tax credit for up to 50% of qualified wages that are paid to employees between March 12th and December 31st of this year. It's applicable to employers and including the nonprofits, if there is a full or partial suspension of your business operation because of government orders. So for businesses right now that had to close up because of the governor's order, but it also applies if for businesses, nonprofits that have a significant decline in gross receipts. Now, the qualified wages, it can be up to up to $10,000 in wages. The $5,000 means that if you get the 50% credit, then you get, in essence, $5,000 back from that. And it does include health care expenses also. Now, if your business has more than 100 full-time employees, the wages, what's considered the qualified wages, are the wages that are paid to employees who are not providing services because there's been a full or partial suspension of your operations or because there's been a significant decline in gross receipts. If your nonprofit has less than 100 full-time employees, then there's no limitation on that. It is for any wages that you pay to an employee, regardless of whether the quarantine or the decline in gross receipts. Again, this is a credit against federal deposits, and so it's retained against the withheld federal income tax withholdings, the employer and employee share of Social Security and Medicare. Similar caveat with this one is that if you have applied for a loan under the PPP, the Payroll Protection Program, you are not able to utilize this credit. And for any wages that you paid under the FFCRA, you also cannot, again, double dip and apply for the same credit here. But it is for any other wages that you're paying during that time. Some other tax relief that you should be aware of, excuse me, is the charitable. First is what you may have heard is that individuals who use a standard deduction can deduct up to $300 in cash contributions to nonprofits. Now, this is, usually if you do cash contributions to nonprofits, you're only really going to take those into account when you itemize your deductions. But with the Tax Act of 2017 and the increase of the standard deduction, that largely went away, and it didn't really provide much incentive. Most people were using the standard deduction. But what this allows is that individuals can still give up to $300 and still use the standard deduction to provide some incentive for donating to nonprofits. Now, it does seem that this is a permanent change. From what I've read, this is not a temporary thing just for 2020, but this seems like a permanent change. The other incentive is generally an individual is limited at 50% of their giving to, they can give up to 50% or at least have it counted as a deduction, 50% of their adjusted gross income. That limitation is temporarily suspended for individuals. And similarly for corporations, they have a limit of 10% for donations for cash contributions to nonprofits. That has been increased to 25%. Again, those are both these limits that are suspended. It is just for 2020, and those go back into effect after that. One thing that I'll just mention as well is that for net operating losses, this comes under the CARES Act also. Net operating losses can be carried back for 5 years for any NOLs in 2018, 19, and 20. This really is going to come into play for nonprofits if you do have unrelated business income. But it's a way of going back and offsetting the income that has been generated. And again, helps the business stay afloat. The other thing that I want to talk about and address is some of the things that the board should be doing. And Jamie will probably cover some other things as well, just some common sense. But one of the things to keep in mind is, as a board member of a nonprofit, you still have a fiduciary duty to the organization. It's a nonprofit, so you don't have a duty to shareholders, but you have it to the organization and to its purposes. So make sure that you are still holding regular meetings. Make sure that you, especially the ones that are governed by the bylaws that need to happen annually or regularly, make sure in the bylaws that there's no restriction against doing remote meetings. By default, under California statute, a meeting can be held remotely with directors as long as every director can communicate with each other simultaneously. So if your bylaws say nothing about it, then you can do remote meetings. Also, you may need to do special meetings to make certain decisions that just need to be addressed. Call those meetings, make sure that you're given proper notice according to the bylaws, and also that you are, if you're not doing the notice, then get a waiver that's going to be signed by everybody. I promise I really do just have a tickle in my throat. Not sick.
Just note that we've all moved away from him.
They have all, yes, they have slowly moved away from me. The other thing is to remain actively engaged. Not the time to put your head in the sand, but by the fact that you're on this conference call indicates that you are not doing that. You are actively engaged. Seek options to keep the organization afloat with the payroll protection program. And also, if a board member cannot attend, make sure that they let the other board members know. Delegate authority. Delegate authority, maybe for the day-to-day operations. Obviously, if there's any big decision that needs to be applied for or decided upon, such as applying for the PPP, those need to be made as a board. Those should not be delegated to an individual. But other maybe mundane decisions or actions that need to be taken, delegate authority on that and record it into the corporate minutes or into resolutions that are signed by all the directors. Make sure you're also maintaining the roles between management, who is doing the day-to-day stuff, and the directors. The board of directors, don't overstep boundaries and overstep your role. But, and then kind of just summarizing this is just to communicate as frequently as needed. So just to make sure I was clear though with the board meetings, you can hold board meetings remotely. You can do these via teleconference or video by default. The only thing that I'm suggesting is check with your bylaws to make sure that they do not prohibit that in any way. If they don't, then you're good. So with that, I'm going to turn some time over to Jamie to address his portion.
Thank you, Aaron. Appreciate it. It's really nice to be in the room with, or on the line, I should say, with people, including people I work with who are more conversant with and have other areas of expertise. I think I've learned a lot just sitting here, so thank you. Let me talk briefly to start with. Some of it may be a recap if any of you have participated in prior webinars, or I don't know if you participated in a webinar or listened, I should say. You all have seen in the news that Congress recently passed supplemental legislation to continue to provide funding under the CARES Act to various places, including to the PPP program. And I read this morning that the president signed it. As far as an order of magnitude, I think it's a $480 billion funding package. I've written somewhere how much of that is earmarked for the PPP, although I don't see it in my notes. So first off, 501c3s are eligible, as Aaron said, for the Paycheck Protection Program loan. I'm going to briefly talk about the elements of it and suggest to you that if you qualify, it's something you ought to be on immediately. With the most recent, prior to today, legislation that funded, I think it was $350 billion. I'll just kind of give you some anecdotes about what our clients have seen and dealt with. You obviously saw in the news that that money ran out, rather quickly. All you can do really, so there's more money available. If your application's not in, get it in. If you have a relationship with a bank, well, you all have banks. Contact your relationship person. find the contact person at the bank who can shepherd your application, get it to them, and call them twice a day. And if you haven't done this, that's what you need to do, assuming you qualify, especially because the main component or the most attractive component to the PPP is not just the funding, but it's actually the loan forgiveness. Unfortunately, as of today, as I understand it, 501c6s are not eligible for the PPP. And there were some lobbying, some proposed amendments. I don't think it changed. So if you're a direct marketing organization or a trade association, as I understand it, you are not currently eligible for a PPP, but there are other stimulus package programs that you are eligible for that I will tune you into. So with the PPP, as I said, 501c3s and then also 501c19s, which are veterans organizations. I'm not sure if I saw any on our internal sign-up sheet. If you're in operation as of February 15th, 2020, and have 500 or less employees, you are eligible. As I said, 501c6s and also 501c4 social welfare organizations are not eligible for PPP. So the application is relatively, well, that was timely. A 501c4 organization is not eligible for a PPP loan, but I do believe eligible for the other types of assistance that we'll get into. So the PPP is attractive. It is administered by the SBA, in which is a big change because prior to this, nonprofits are not eligible for SBA funding under prior applicable regulations and laws. So under 500 employees, up to $10 million at an amount that is the lesser of $10 million or 2.5 times the average total monthly payroll costs from the prior year, not including independent contractors. The interest rate is 1%. There are other certain calculations that go into the loan amount, such as not including any employee's annualized salary that exceeds $100,000, certain federal employment taxes, and also qualified sick and family leave wages for which a credit is allowed under the FFCRA. So the application, I believe, is relatively, well, it's simple, it's short compared to other financing applications. Like other SBA, I should say different from other SBA funding and loans. Personal guarantees or collateral is not required. The loan amount accrues interest at 1%, although payments deferred for 6 months with interest accruing, and then the principal repayment due in 2 years with no prepayment penalty. But the key to all of this, which I'll get to, is the loan forgiveness. As I understand the regulations, nonprofits may not apply for a PPP loan more than once. And so make sure you calculate your absolute maximum potential loan amount at the outset. Otherwise, if you find an error or miscalculate, you may have an issue there. So the PPP loans permissible uses include payroll, including paid leave, health insurance premiums, retirement benefits, mortgage interest repayments, rent, utility costs, and interest on other debt obligations. So subject to some limitations. The full principal amount of the PPP loan is eligible for forgiveness to the extent it is used during the 8-week period starting on the loan origination date for payroll costs, rent, and utility payments, noting that no more than 25% of the loan forgiveness amount may be attributable to non-payroll costs. There's some reductive formulas that come in there depending on what the money is used for. Obviously, it's going to be important if you get funded to budget accordingly and obviously review the loan forgiveness calculations and potential reductions and budget your cash uses accordingly. That's just a very brief overview of the PPP loan program, which you've heard all about. A second loan program, which is a little bit different, and the main difference, I guess, is that there's no forgiveness component, unfortunately, which is the Economic Injury Disaster Loan, which folks have been referring to as the EIDL program. And this program is available for most nonprofits. They're not charities or veterans organizations. And the eligibility defines and includes private nonprofit organizations as eligible, which is a term of art defined in federal regulations that require either an IRS determination letter stating the organization is organized under 501C, D, or E of the code, or satisfactory evidence from the applicable state that the applying organization is a quote-unquote non-revenue producing nonprofit organization or entity that is organized or doing business under state law. So, sounds like a kind of broad eligibility criteria, although it's probably rare, depending on what type of organization you are, that you have an IRS determination letter. For example, churches, social welfare organizations, unions, and business leagues don't often have those determination letters. The eligible nonprofits can apply for a loan amount under EIDL for up to $2 million. I believe it's a 2.75% interest rate right now. The actual loan amount is based on the amount of economic injury sustained. Repayment terms are determined by eligibility to repay, with deferrals of payment for up to 4 years. EIDL loans may be used for payroll, accounts payable, and other debts that cannot otherwise be paid due to the impact of COVID-19. So another difference then in the PPP program and the EIDL is that the EIDL is for use for a demonstrated inability to pay debts or obligations directly related to COVID-19, whereas the PPP requires no such certification and is simply available so long as you fulfill the criteria. And again, no loan forgiveness under EIDL. The final potential economic assistance component of the CARES Act is for our federal loans to mid-sized and large organizations that people refer to as the part of the Industry Stabilization Fund. And these are direct loans for nonprofit organizations with between 500 and 10,000 employees, and it's believed that that encompasses all forms of nonprofit organizations. A certification that the loan is necessary to support operations, and also that the funds will be used to retain or restore 90% of the workforce that was in place on February 1st, 2020 at full comp and benefits until at least September 30, 2020, that the nonprofit will not outsource or offshore jobs or abrogate collective bargaining agreements is required. I don't know, I'm not aware of a limit on that loan amount. They carry rates of 2%. Loan durations, I'm reading, are up to 5 years, although repayment terms are a little bit in flux, and you should be discussing with your financial institution. Aaron talked a little bit about the expansion of tax deductions for charitable contributions. Both Liz and Aaron talked about the employee retention payroll tax credit. I would also note that churches and other religious organizations do appear to be eligible for both PPP and EIDL loans. Eligibility previously potentially in question due to constitutional issues, and also SBA regulations currently bar loans to certain types of religious organizations. However, on April 3rd, the SBA issued a directive or provided their view that loans to churches are permitted, notwithstanding these potential church and state issues. Just a final few comments about economic assistance for nonprofits specifically. There do not appear to be any problems or issues with nonprofit organizations applying for and taking advantage of both CARES Act loans and other government grants, which can sometimes be restricted and also restrict other types of financing that might be available. We simply don't see that, so that's good news. To piggyback a little bit on Aaron's comments, Make sure when you are submitting your PPP or EIDL or Industry Stabilization Fund applications that you cross your I's and dot your T's with respect to proper corporate governance, which includes whatever resolutions are necessary under bylaws or other corporate documents for loan approval. And then finally, do note, if you have other financing, if you have another bank loan, you should review your bank loan documents because there may be restrictions in there on other types of financings that can be provided or requested, certain reporting requirements. I'm not aware of, let me go back. It may just be a situation where third-party consent from an existing lender might be required. So I suggest you do that review and if necessary, reach out for that consent. That's all I'm going to talk about with respect to the economic assistance packages. Piggybacking and adding to Aaron's comment about board governance, which in situations like these are extremely important. I'll put another little shot across the bow here, which is to say, in addition to the fiduciary duties that directors and officers owe the organization, in an insolvency situation, there's a body of law that provides that board members also begin to owe fiduciary duties to creditors, which is a little bit scary. So in California, it's called the trust fund doctrine. The purpose, I suppose, is to ensure that board members are acting appropriately. So it's not actually really, I wouldn't view it as an expansion of fiduciary duties because a breach of this type of duty under California law, at least, is somewhat limited. And it applies to things like if you're a board member or if you're a director or an officer, don't necessarily, if your organization is insolvent, approve repayment of obligations to your friends and family and leave other people out in the cold. Don't make sure that you are paid in full and other people are not. So things like that, which might seem common sense and which I don't think are quite different from the more general fiduciary duties owed the organization, I guess I'm just flagging this to be so that folks are aware that when there are not enough funds to go around in an organization, you got to be careful what you do with them. Taking risks, for example, you have to be more careful of in these situations. Piggybacking on Aaron's comment, review all aspects of your operations, get input from legal or financial advisors when necessary, hold board meetings, follow good corporate process, avoid conflicts of interest. That will continue to put you in good stead. And also, assuming you do that, you will be protected by a business judgment rule, which board members must satisfy, or if they do, they satisfy their fiduciary duties. With respect to their current economic outlook, I think it's very important right now for all organizations, nonprofit, for-profit, everybody, to do as much planning as possible. We all understand that there's a lot of unknowns about what's happening for nonprofits, when your giving is going to come back, whether you're going to be able to reschedule your annual gala or your annual fundraiser, and how this is going to work. I think it's incumbent, however, to engage in internal financial planning and projections that take as many different eventualities into consideration as you're making decisions going forward. I'm going to touch very briefly, real briefly. We did have some prior questions, bankruptcy questions. One question was, what's the difference between Chapter 7 and Chapter 11? And although some of you hope never to have to talk to me or another bankruptcy lawyer about this, I'll just give that quick overview just so you have a little bit of background. A Chapter 7 bankruptcy is a filing in which the organization is closing its doors. Upon the initiation of the bankruptcy petition, which is a document filed with the bankruptcy court, all the assets of the organization become what's called property of the bankruptcy estate, which is probably best viewed as like a trust race or a trust corpus, and an independent third-party fiduciary who's a Chapter 7 trustee is appointed to administer those assets for the benefit of creditors, obviously with a nonprofit, not for the benefit of anyone else. Interestingly, corporations do not get what's called discharges in bankruptcy cases, which for individuals, for example, is the end goal of getting through bankruptcy is you get out of all of your debts you owed as of the petition date. So there's a limited utility, I believe, to a nonprofit or toward any corporation filing a Chapter 7 bankruptcy case. The only one that I can suggest or argue is appropriate is that I believe that if your organization is insolvent or you are near the zone of insolvency, which can mean a whole bunch of different things. It means you can't pay their debts when they come due. It could mean your liabilities are greater than your assets. As I said earlier, for board members, there is this potential additional fiduciary duty in the insolvency area or in the zone of insolvency. And one way to potentially discharge that duty is to turn things over to the bankruptcy trustee, because then you're not making these very difficult decisions about who to pay and who not to pay, especially, for example, when you can't meet payroll. That is a very difficult situation. So Chapter 11 is what you've all heard of in the news, which PG&E is thrashing about in the Northern District of California. Chapter 11 is most appropriately used or most beneficially used for nonprofits, I should say, you've heard the term reorganization, and really what that means is a reorganization of your balance sheet. And what Chapter 11 allows an organization to do is it creates a dividing line on the date the bankruptcy petition is filed between debts that were owed pre-petition, i.e. meaning before that date, and debts that arise post-petition, meaning after that date. And what the Chapter 11 process ultimately allows a nonprofit organization to do is put a hold on, and in fact you can't pay any of the pre-petition debts, and gives you an avenue to restructure those and pay them over time. So it's really one way to think about it is really a potential cash flow savior. You can put things on hold, pay them back later. There's a lot of ins and outs there. That's really just a very, very, very kind of basic description. I'm gonna stop talking about bankruptcy and scaring everybody there. But a couple of resources. I was going to talk a little bit about fundraising issues, and we had some discussion here internally about it. I would just suggest to you, I found a really good article on philanthropy.com, which is an article written on March 19th, 2020 in the Chronicle of Philanthropy, titled Fundraising During the Corona Outbreak, Answers to 5 Pressing Questions. Talks about such things about rescheduling events, how to reach out to donors, how to do it appropriately and not appear tone deaf, and how to keep your donor base engaged. So I'll just throw that out there for you as a nice resource that we found for some of our clients. I think that's all we have today. So our presentation is concluded. Thank you all so much for listening. I almost said participating again. We don't have we've been having weekly Friday webinars, I think for the past six weeks. We don't have one scheduled for next Friday, but we do anticipate coming back further online on a little bit less truncated basis. If any of you have any questions or follow-up, feel free to reach out to any of us, or if you're a client, whoever your contact is at the firm. And again, thank you, everybody. At least in Sacramento, it's gorgeous outside, so hopefully you can go for a walk later this afternoon. Thank you again.